All right, let's start with a quick review of our terms. First, we have the APR, annualized percentage rate. So the APR is always a stated rate, and it will be in annual terms. Okay, and accompanying the APR, we always have some statement of how compounding will occur. And so in this case, compounding is going to occur monthly. And so what that means is a month will pass, interest is calculated, it's added to the account, and then we continue going forward into the next month. And so interest is earned on interest after the first month. The other term here is the effective annual rate, or the EAR. So an EAR is an equivalent rate that will generate the same future value after a year under annual compounding. And so if compounding were annual instead of monthly, the EAR would get us to the same future value after a year. And so the calculation of the EAR looks very much like the calculation of the future value of $1 under the APR. And so the way that works is we want to think about what would happen if we were calculating the future value of $1 using the APR. Okay, and so we know that in order to do that, we first have to convert things to a periodic rate. And so that calculation is going to look like this. We're going to take the APR, divide it by this number M, which is just the number of periods per year. And if we're calculating the future value of $1, we just multiply 1 by 1 plus this periodic rate. So here's the periodic rate. And then raise that to the nth power. And so here we have monthly compounding, so M is 12. Okay, so this little formula right here, again, is going to tell us the future value of $1 after a year. All right, and so what we're after, again, with the EAR is an annual rate that gets us to the same place. And so if we took that same dollar and grew it at some rate we call the EAR with annual compounding, we're going to get to the same future value. And so to make this a little bit more simple, then here's our formula. And so for this problem, we enter our APR, which is 9%, divide that by 12, so there's our periodic rate. Raise it to the 12th power. That's going to be equivalent to 1 plus the EAR. And so from here we can solve for the EAR, and we will get 0.0938, or 9.38%. So there's the answer. And so again, the interpretation is we could either invest at 9% using monthly compounding, or 9.38% using annual compounding, and we'll get to the same future value.